There's a growing belief across crypto right now that digital asset treasuries or DATs could be the single biggest risk to Solana. Billions raised, billions deployed, and billions in returns were promised. But after months of hype, a brutal truth is finally emerging. Holding DAT stocks has actually been far worse than simply holding SOL. Some DAT shares are down 30, 50, even 70%. mNAV premiums have collapsed, and the very flywheel that was meant to pump SOL to new all-time highs might now be the thing threatening its stability. So today we're investigating the real state of Solana DATs, the bull case, the bear case, and whether the DAT model popularized by Michael Saylor's strategy could actually crash crypto markets entirely. So do me a favor and smash those like and subscribe buttons. It really helps our channel grow, and it makes sure that more people can see the video and be better informed of some of the risks facing our industry. Once Michael Saylor's strategy was deemed crypto's most successful company to go mainstream, it was inevitable that the same model would be duplicated across assets like ETH, SOL, and XRP. And that's exactly what happened, or at least so we thought. Because with billions of dollars raised to buy SOL, digital asset treasuries, or DATCos, or just DATs quickly became the Solana ecosystem's knight in shining armor. Finally, we made it to Wall Street. Finally, TradFi money was pouring in to buy the same assets that retail owned. It was all anyone, including Solana co-founders, could think about and talk about for months leading up to those ETF approvals. And let's not forget that even the degens started piling in to buy these stocks issued by Solana DATs, while detractors screamed from the sidelines that it was a risky house of cards. But then the unthinkable happened. MicroStrategy's market cap fell billions of dollars below the value of its Bitcoin holdings.
The Treasury company is taking a sharp leg lower today. Strategy dropping nearly 10%, hitting its lowest level in over a year. Mara Holdings, Riot, even Coinbase coming down with it. That as Bitcoin prices dip back below 90,000, the crypto hitting a new 7-month low.
The DAT stock prices started to plummet 30, 50, even 70% from their all-time highs. Market caps and mNAVs followed the same trend as we can see here. Now fast forward to today, and crypto's love affair with Michael Saylor and MSTR seems to be ending. All of a sudden, those vocal detractors like Beanie, who had long argued that DATs posed systemic risk to us all, were no longer overly skeptical, sidelined haters. They had become the voice of reason. Even the mainstream media started poking fun at this situation.
Dan, you're remarking about the Treasury companies.
Yeah, I mean, one thing I've just mentioned is like these became meme stocks, right? And I think that's why, just like they overshot to the upside, they have the potential and they will likely overshoot to the downside.
Now today, there's no doubt in anyone's minds that holding DAT stocks has been far worse than holding SOL. But still, not everything is as it seems with digital asset treasuries. So the real burning question that we have to address here is whether or not these billions of dollars raised by DATs actually pose a significant systemic risk to the entire industry. Let's start with the raw numbers to get a sense of the sheer size and ambition of some of these DATs. Because MicroStrategy alone now sits at around $48 billion in assets. Tomny's Ethereum treasury called Bitmine is another behemoth which you've undoubtedly heard of, and it now holds around $10 billion of ETH despite the share price rapidly nosediving. And on Solana too, we've seen massive treasury vehicles emerging. Forward Industries leads here with their $1.65 billion pipe, and their holdings, worth over $500 million, currently represent 45% of the total DAT landscape. Sol Strategies, DeFi Development Corp, and Upexi all hold hundreds of millions of dollars of SOL today as well. Now, if we filter DeFi Llama's treasury tracker by Solana DATs, we see a total of 16 million SOL, worth over $2 billion is held by these vehicles. This isn't small money, these are institutional grade raises. But despite the price crashes, Saylor still maintains that his position is tenable.
What do you think? 150 by the end of the year? What do you think's happening here?
You know, I think we all want to go to the moon, but if you want to ride the rocket, you got to be prepared to pull the G's. Over 5 years, Bitcoin's had like 6 brutal drawdowns. So I think the volatility comes with the territory. If you're going to be a Bitcoin investor, you need a 4-year time horizon, and you need to be prepared to handle the volatility in this market.
Now, Saylor aside, if we zoom out and we look at this chart of the top 20 DATs overall, we see that every single Solana DAT mentioned has an mNAV below 1, which is an alarming reality to say the least. But why does this matter for Solana, and why might we be looking at systemic risk? As much as DATs long argued that their sole objective was to increase their SOL per share, in other words, only accumulating more SOL without ever selling any, the reality is that that might not always be a reasonable objective. Because here's the real systemic risk suggested by critics. If SOL was to drop far enough in price, DATs with debt-based structures must sell their SOL to meet their obligations. And if they sell millions of tokens into a thin market, mNAV becomes even further compressed. triggering more selling, which triggers even lower mNAV, and this is exactly how death spirals form. But to understand the nuance and a counter-argument as to why some SOL DATs actually stand to benefit from this volatility, let's listen to Michael Marcantonio's explanation to Solana floor.
MSTR has a 1.77 beta to Bitcoin. That means when Bitcoin goes up 100%, MSTR goes up 177%. When Bitcoin goes down 100%, MSTR goes down 77%. So it's much more volatile than Bitcoin. And it weaponizes that volatility to access superior terms for global finance and global borrows. Now enter the Solana DAT. Solana is about 51% more volatile than Bitcoin. Solana DAT, with a more volatile underlying asset, could get even better terms in the convertible debt markets.
So clearly, the Solana DAT model, and Ford in particular, is in some ways an improvement over Michael Saylor's MSTR. But that's actually not even the most bullish argument made in favor of these DATs. Here's Michael once again explaining the bull case, and this time backing it up with a $100 million argument.
Solana generates free cash flows. So the DAT that Galaxy sponsored, Ford Industries, we raised in one of the largest pipes in history, $1.65 billion, that we immediately then turned around and bought Solana. So Ford bought Solana. And that $1.65 billion of SOL that Ford was able to purchase is staked right now. That SOL will generate north of $100 million of free cash flow every single year, just simply by virtue of being staked.
Unlike MSTR, which earns zero yield on BTC, Solana DATs get staking rewards that can help service future debt. But other bullish angles exist as well, because Solana has a thriving DEX ecosystem with more volume than all other chains. It also has the fastest growing RWA and tokenization ecosystem, which now accounts for 95% of all tokenized stock volume, and you can learn more about that in our last video. Now, if you cast your mind back to August, we saw these bullish signs everywhere. Over $1 billion in year-to-date inflows into Solana digital asset products. Solana DATs owning 1% of the entire circulating supply, and Solana-based ETFs like SSK were hitting all-time highs in volume. All of this even reopened the discussion of Solana reclaiming $250, potentially even printing an all-time high in 2025. Now, the argument was that if DATs continue to accumulate SOL during dips, and they increase their SOL per share, and if Solana DAT demand mirrored Ethereum's, then we could see another $1 billion in SOL purchased off the market. So clearly that was the dream scenario: liquidity, inflows, and stability. But then reality arrived. Because by the time November rolled around, the entire script was flipped with the Solana DAT landscape. All of a sudden, when we looked at the 3-month performance of major DATs, we saw that only one of them was in the green. Everything else was down bad. These mNAV premiums, which once gave DATs the ability to raise cheap capital, were collapsing. Almost all of them were trending towards 1. And by December, many of those sacred mNAVs were actually at or even below 1. So for most retail investors, DAT stocks have destroyed shareholder value rather than creating a healthy, leveraged exposure to SOL as they had once promised. Now, certainly not surprising if you understood the risks, but it was very surprising if you bought the hype when SOL was around all-time highs. Because despite the discounted SOL purchases, despite the massive raises, and despite the eye-watering headlines, DAT shareholders have been absolutely crushed in the short term. But are DATs fundamentally broken, or is this just temporary turbulence caused by macro headwinds? Now, that question brings us to the most important section of today's investigation. So here's why, for many people, debt-based DATs are the single biggest risk to Solana right now. The DAT flywheel works great during up-only markets, but the exact same feedback loop also works in reverse, and sometimes even worse, because if mNAV falls, they can't raise capital. If they already took on debt, they may even be forced to sell their SOL, depending on the type of financial alchemy being employed. Now, forced selling means a lower SOL price, which means more forced selling, and eventually it all comes crashing down. Now, this threat is especially real because some DATs have secured convertible notes tied directly to their SOL holdings. So lenders could, theoretically, seize assets or force the sale if liquidation thresholds were hit. Crypto degens sometimes joke that DATs are just TradFi exit liquidity for us Solana natives. But in a downturn, this becomes anything but funny, because we're then looking straight down the barrel of systemic leverage, and systemic leverage breaks things. The Solana community, ironically, has adopted a no crying in the casino mentality, where many people think, and they publicly argue, that if DATs push the SOL price up, then who cares? Let TradFi get wrecked, pump my bags. But here's the glaring flaw in that logic. If a DAT unwinds due to leverage blowup like we saw on 1010, it's not their bags getting nuked, it's yours. And that leads us to the question everyone's talking about. Are DATs still a bullish structural upgrade to Solana, or did we sit by as TradFi fellas came on chain and used clever financial alchemy to create what is literally a ticking time bomb?
The next crypto winter will be a nuclear winter. because what will happen is these DATs will trade at discounts. And I'm not saying all DATs are bad, but there'll be a lot of DATs that will acquire a lot of coins for a certain project. They will trade at a massive discount. Now, the hedge funds come in, they go, okay, we can just go raise 2, 3, 4, 5 billion, whatever it is. We'll buy up the company, but we're going to short before we buy it up. And then we're going to dump it on the market and get extra leverage. We're going to shank the price down 90%.
Now, it's difficult to not be biased here, but do DATs pose systemic risk? Yes, absolutely no denying that the cumulative risk posed by all DATs amounts to nothing short of systemic risk. But is it a guarantee to blow up Solana? No, and here's why. Solana's underlying fundamentals are the strongest in the industry right now. We're looking at the highest user growth on the most active chain with the fastest growing tokenized equity sector, some of the strongest developer retention, and most obviously, a rapidly growing stablecoin and RWA footprint. But perhaps even more importantly, Sol DATs only represent about 3% of total circulating supply at the moment. So it's probably better to think of DATs as a layer on top of Solana rather than being a systemic risk from within Solana itself. Now, don't get me wrong, if one of the bigger DATs blows up, it could absolutely tank the market in the short term. But in the long term, Solana's not reliant on DATs. If anything, DATs are more reliant on Solana. And that's the key difference between now and 2022, when FTX nuked the entire ecosystem overnight. So the question for you is simple. Which camp do you sit in right now? Do you, like many people, think that DATs are net positive for Solana, that they bring high-yield investment opportunities to institutional investors who want to accumulate Sol and deploy it across Solana DeFi? Or, like many other people, do you actually see them as a ticking time bomb that's waiting to unwind? Drop your thoughts in the comments, I will be reading them all, and as always, this is not financial advice. But if the video gave you any clarity, then please hit the like button so more people can see it. And if you get any value at all from our content, then please subscribe for more investigative deep dives, and I'll see you next time for more of the latest.